Silver just did something it hasn't done in months. It broke through $65 an ounce. And the move happened in a matter of hours, not because of a mining shortage, not because of a supply shock, but because of three numbers buried in a jobs report. Numbers that just changed what the Federal Reserve does next. And if this is the beginning of what some analysts are calling the real breakout, the investors who aren't paying attention right now are going to be the ones asking what happened. Welcome back to Currency Arc Insight, the channel where we cut through the noise of daily headlines to show you the real forces moving gold, silver, and the global economy before the mainstream catches up. Silver has just delivered one of its most dramatic single-day moves in months, and the scale of it demands attention. In a matter of hours, the price surged from an opening level near $61.85 to a session high of $65.22, a move that caught even seasoned market watchers off guard. This was not a slow grind higher. It was an explosive spike, the kind of price action that tends to signal something larger is unfolding beneath the surface. To put the magnitude of this move into perspective, silver climbed more than 3% intraday, a significant shift for a metal that had spent recent weeks consolidating within a narrower range. This was not an isolated move either. Gold rallied alongside it, gaining roughly 2.33% to trade near $4,140 an ounce. Platinum and palladium also advanced, confirming that this was a broad-based rally across the precious metals complex rather than a silver-specific anomaly. When multiple metals move together with this kind of force, it typically signals a macro-level trigger rather than a market-specific development. Silver was not reacting to a mining disruption. It was not responding to a sudden supply shortage or a shift in industrial demand. The catalyst originated elsewhere, in a place many retail investors overlook entirely: economic data releases that shape expectations for monetary policy. This is a critical distinction for investors to understand. Silver's price is influenced by industrial demand and physical supply constraints over the long term, but its short-term volatility is often driven by something far less tangible: shifting expectations about what central banks will do next. When those expectations move quickly, capital moves quickly with them, and that is precisely what happened here. Zooming out further, this single-day breakout did not occur in a vacuum. Silver has been building strength over recent weeks, climbing more than 8% in a relatively short window and outperforming gold, platinum, and palladium in the process. That outperformance is itself a signal worth noting. Silver has historically demonstrated a tendency to lag gold during the early stages of a precious metals rally, then accelerate sharply once momentum builds, a pattern often described as silver's high beta relationship to gold. The recent price action fits that historical pattern closely. At the same time, the US dollar has been losing ground, slipping to levels not seen in recent weeks. A weakening dollar tends to provide tailwinds for precious metals, since gold and silver are priced in dollars globally and become comparatively cheaper for holders of other currencies as the dollar declines. This dynamic adds another layer of support beneath the recent surge, reinforcing that this move was not purely speculative in nature. What makes this moment particularly significant is the question it raises for investors watching from the sidelines. Is this the beginning of a sustained breakout, one built on shifting macroeconomic fundamentals that could carry silver meaningfully higher from here? Or is this simply another sharp spike destined to fade once the underlying catalyst is fully priced in by the market? That question cannot be answered by looking at the price chart alone. It requires understanding exactly what triggered this move in the first place, and that trigger traces back to a single consequential piece of economic data released just before markets closed for the week. A data point that, on its surface, appeared to be bad news for the broader economy, but which the market immediately reinterpreted as a signal for what comes next from the Federal Reserve. That single data release did more than move markets for a single trading session. It reshaped expectations for monetary policy heading into the fall, and in doing so, it may have opened the door to a much larger move in precious metals than most investors currently anticipate. Understanding exactly what happened and why it mattered so much is essential to understanding whether silver's breakout above $65 has genuine staying power. To understand why silver exploded higher, investors need to look past the price chart entirely and examine a single economic release that arrived just before markets closed for the week. The Bureau of Labor Statistics reported that the U.S. economy lost 23,000 jobs in July. This was not a minor miss. Economists had projected a gain of roughly 80,000 jobs alongside a stable unemployment rate. Instead, the labor market delivered an outright contraction, and the unemployment rate ticked up to 4.1%. The gap between expectation and reality here is what matters most. Markets do not simply react to raw numbers, they react to surprise, to the distance between what was anticipated and what actually occurred. An 80,000 job gain that came in weaker than expected would have been a modest disappointment. A swing from an expected gain into an outright loss of 23,000 jobs is an entirely different signal. and it immediately reshaped how traders positioned themselves heading into the fall. The reason this single data point carries so much weight comes down to one institution, the Federal Reserve. Heading into this report, there had been genuine hope that a resilient labor market would give the Fed room to hold interest rates steady without added pressure to cut. A strong jobs number would have suggested the economy could absorb higher rates a while longer, keeping inflation-fighting policy intact. This report undercut that narrative entirely. Within hours of the release, market-implied expectations for Federal Reserve policy shifted meaningfully. For the Fed's September meeting, odds began favoring a rate hold over a hike by a considerable margin, essentially flipping the prevailing narrative that had existed just days earlier. Looking further out to the October meeting, expectations for a rate increase collapsed to a minority position, with only a modest probability now assigned to any hike materializing by then at all. This is precisely the mechanism through which weak labor data becomes rocket fuel for precious metals. Gold and silver do not generate yield. They do not pay dividends or interest. Their appeal, historically, strengthens whenever the opportunity cost of holding them declines, which is exactly what happens when interest rate expectations fall. A Federal Reserve less likely to raise rates and more likely to eventually cut them directly reduces the competitive advantage that interest-bearing assets hold over metals. Capital that had been sitting on the sidelines, waiting for clarity on Fed policy, found that clarity within minutes of the jobs report, and a meaningful share of it, flowed directly into silver and gold. There's also a psychological layer to this move that deserves attention. Markets had been bracing for a strong report, one that might reinforce the case for higher for longer interest rates. When the opposite occurred, the surprise itself amplified the reaction. Traders who had been positioned for a hawkish outcome were forced to rapidly unwind those positions, adding additional momentum to an already sharp move in precious metals. This is a pattern long-term investors should recognize and internalize. Silver's price action is frequently driven less by what is happening in the physical market for the metal itself, and more by shifting expectations around monetary policy, interest rates, and the value of the dollar. A single labor report, released on a Friday afternoon, was enough to send silver through a key psychological level and reshape the market's expectations for the months ahead. But the jobs report itself raises an uncomfortable follow-up question, one that a growing number of market participants are beginning to ask openly. Was this simply an unexpected economic slowdown showing up in the data? Or is there a more complicated story behind these numbers, one involving how economic data gets calculated, revised, and released in the first place? That question does not have a clean answer, but it is one that deserves serious examination, because if the data itself is in question, then so is every conclusion the market has just drawn from it. Beyond the raw numbers themselves, a more provocative narrative has begun circulating among market participants and financial commentators, one that goes beyond simple economic analysis and into the realm of institutional trust. The question being raised is this: was July's dismal jobs report simply an accurate reflection of a slowing economy? Or could there be a more complicated story behind how that data was calculated and released? This skepticism did not emerge from nowhere. Earlier in the year, a senior official at the Bureau of Labor Statistics was removed from their position amid allegations that economic data was being mishandled or presented in a misleading way. That episode left a lingering distrust among some market participants, a sense that the numbers coming out of federal agencies may not always tell the full story. When a jobs report as dramatic as this one arrives, that history resurfaces in the minds of skeptical investors. Adding to the complexity, part of July's job losses have been attributed to the natural winding down of temporary employment tied to a major global sporting event held earlier in the year. As those temporary positions concluded, they mechanically subtracted from the employment count, contributing to the negative headline number. This is a legitimate economic explanation, but it also raises a fair question. If this effect was foreseeable, why wasn't it already factored into economists' expectations ahead of the release? Compounding this further is the recurring pattern of downward revisions to prior months' employment figures, a trend that has repeated itself throughout this cycle. Initial job numbers are released only to be quietly revised lower in subsequent months once additional data becomes available. Individually, a revision here or there might be dismissed as a routine statistical adjustment. But when this pattern repeats consistently, it fuels a broader narrative that initial reports may be systematically overstated, only to be corrected downward after the market has already reacted to the original rosier figure. This has led some observers to speculate about motive. Could weaker economic data, whether through genuine economic softening or through the mechanics of how that data gets compiled, be serving a broader policy objective? A weaker labor market gives the Federal Reserve more justification to lower interest rates, which in turn would ease pressure on a federal government carrying debt levels now approaching $40 trillion. Lower rates reduce the government's own borrowing costs, creating a scenario where a struggling labor market and a strained federal balance sheet may, whether by coincidence or design, point toward the same convenient policy outcome. To be clear, this remains speculation rather than established fact. There is no definitive proof that economic data is being manipulated to engineer a particular Federal Reserve response. Reasonable people can and do disagree on how much weight this theory deserves. But the fact that this conversation is happening at all, openly and among serious market participants, is itself meaningful. It reflects a broader erosion of confidence in official economic data, one that has been building for years and shows no signs of reversing. This erosion of trust matters enormously for precious metals investors specifically, because gold and silver have historically served as a hedge against exactly this kind of institutional uncertainty. When confidence in government data, currency stability, or monetary policy credibility weakens, capital tends to migrate toward assets that exist outside that system entirely. Physical gold and silver cannot be revised after the fact. Their value is not subject to a data release or a policy committee's discretion. That is precisely why moments like this one tend to reinforce, rather than undermine, the long-term case for holding precious metals. Whether or not this particular jobs report was influenced by anything beyond ordinary economic softening, the broader lesson for investors remains the same. Relying entirely on official data to time markets is an increasingly uncertain strategy. But data integrity is only part of this story. The other major force behind silver's move involves matters far beyond domestic economic policy, extending into currency markets and geopolitical developments unfolding on the world stage. While the jobs report and the questions surrounding it explain much of silver's sudden move, the full picture extends well beyond domestic labor data. Two additional forces have been building in the background, and both deserve close attention from anyone trying to understand where silver goes from here. A weakening US dollar and a developing geopolitical situation half a world away. Start with the dollar. In the wake of the disappointing jobs report, the US dollar index has continued sliding, slipping toward levels not seen in recent weeks. This matters immensely for precious metals investors, because gold and silver are priced globally in dollars. When the dollar weakens, it takes fewer units of foreign currency to purchase the same ounce of metal, effectively making gold and silver cheaper for buyers outside the United States. That increased affordability tends to draw in additional global demand, adding fuel to a rally that domestic investors may already be participating in for entirely different reasons. This dollar weakness does not appear to be accidental or incidental. It fits within the broader narrative already discussed. Weaker economic data increases the likelihood of Federal Reserve rate cuts, and lower interest rates historically place downward pressure on a currency's strength. Whether one views this as an organic market response or a more deliberate policy outcome, the effect on precious metals remains the same. A softer dollar has historically served as one of the most reliable tailwinds for gold and silver prices. The second major force unfolding involves geopolitics, specifically developments surrounding the Strait of Hormuz, one of the most critical choke points for global oil transportation. Reports have emerged suggesting the possibility of a diplomatic agreement between Oman and Iran, one that could ease tensions in the region and reduce the risk of disruption to oil shipments passing through the strait. Notably, the current U.S. administration has not publicly opposed these discussions, lending the prospect additional credibility in the eyes of the market. At first glance, a potential peace agreement might seem like a bearish development for precious metals, since geopolitical stability is often associated with reduced safe haven demand. But the reality here is more nuanced. Markets are currently starved for consistency and predictability after an extended period of uncertainty. A credible path toward regional stability, even a partial one, tends to support broader risk sentiment while simultaneously keeping inflationary pressures contained, since oil prices would likely stabilize rather than spike sharply higher. That combination of contained energy costs alongside a still accommodative Federal Reserve outlook creates a supportive rather than hostile environment for continued strength in gold and silver. There's an important caveat worth noting. Should any agreement include new fees or tolls for vessels transiting the strait, that could keep oil prices elevated even amid an overall de-escalation, which would complicate the inflation picture considerably. This remains a developing situation, and investors should watch it closely rather than assume a clean, straightforward outcome. Taken together, these dynamics help establish a technical framework for where silver may head next. In the immediate term, the $62 to $63 range has emerged as a key area of support, a level silver would need to hold above to maintain its bullish momentum. Should that support hold and buying interest continue, some market watchers see a path towards $70 an ounce as the next meaningful target, particularly if the current combination of dollar weakness and dovish Federal Reserve expectations persists into the fall. None of these forces exist in isolation. A weakening dollar, a Federal Reserve leaning toward accommodation, and a potentially stabilizing geopolitical backdrop are all interconnected pieces of the same broader story, one that extends well beyond a single jobs report or a single day's price action. Understanding how these pieces fit together is essential for evaluating whether silver's move above 65 ARD represents the start of something larger, or simply another chapter in an already volatile year for precious metals. After walking through everything that contributed to silver's move above $65, the question investors ultimately want answered is simple. Does this breakout have staying power, or is it destined to fade like so many sharp spikes before it? The case for genuine strength is compelling. This was not an isolated silver-specific event. Gold, platinum, and palladium all moved higher in tandem, confirming a broad shift in the macro environment rather than a narrow speculative squeeze. The catalyst traces back to a real economic surprise, a Federal Reserve that appears increasingly likely to ease rather than tighten, and a dollar that has been steadily losing strength. These are not fleeting technical factors. They are structural forces that, if they persist, could continue supporting silver well beyond this single trading week. At the same time, a disciplined investor has to acknowledge the counterargument. Markets often overreact to single data points, and jobs reports are frequently revised in the months that follow. If future data comes in stronger, or if the questions raised about data reliability shift market psychology back toward a hawkish Fed outlook, some of this move could unwind quickly. Silver has a well-documented history of sharp spikes, followed by equally sharp pullbacks, and nothing about this rally exempts it from that pattern. This is precisely why chasing price action in real time is such a difficult strategy to execute successfully. By the time a breakout is confirmed beyond doubt, a meaningful portion of the move has often already occurred. The investors who benefit most from moments like this are rarely the ones trying to perfectly time an entry at the exact bottom. They are the ones who already held a position before the move began, built through patience rather than reaction. Going forward, the $62 to $63 zone remains the level to watch most closely. A sustained hold above that range would reinforce the bullish case and keep a move towards $70 realistically in play. A decisive break back below it, however, would suggest this was more spike than breakout, and that the broader trend requires more evidence before it can be trusted. Ultimately, this single week does not settle the debate. What it does confirm is that the forces driving silver, monetary policy expectations, currency strength, data credibility, and global stability remain firmly in motion. Silver at $65 is not the end of a story. It is a single data point within a much larger, still unfolding narrative about the value of paper currency, the credibility of official institutions, and where capital chooses to seek safety when trust in the system begins to erode. That is the environment investors find themselves in today, and it is a story this channel will continue tracking closely as it develops. If you found this breakdown valuable, take a moment to rate this video, share it with someone who should be paying attention to this market, drop a comment with your own take, and subscribe so you don't miss what comes next.